Welcome everyone. My name is Michael LeBlanc, Director, Senior Portfolio Manager at Canaccord Genuity Wealth Management. Thank you to everyone who's been watching our weekly updates. On every Tuesday, we do a live, everything market related, everything COVID related, just to keep everyone in the loop, what we're seeing out there and what we recommend and actions you can take within your portfolio. Today, I want to talk to you about something a little more immediate, and specifically the price of oil and what's happened this week in the futures markets. Before we get into that, just a reminder to everyone, this is not specific advice for your portfolio. Do seek out professional advice, and any information we give here today is up to date and as accurate as possible, but always double check your information before making any decisions or actions on it. For more information on that, you can visit our website, leblancgroup.ca, or if you're watching this on YouTube, there'll be a link down below where you can double check that. So let's talk about oil and what's happened this week. There's been a lot of confusion about the news of oil dropping to historic lows. What we saw on April 20th for the first time in history is that the US oil traded at a negative number. It dropped by over $50 a barrel to minus $37 a barrel. So how did that happen and how did we get here? And what does that mean going forward? Specifically, what's happened with the COVID crisis is demand has dropped off. It's estimated between 25 and 30% of global oil demand has fallen due to lack of driving, lack of travel with airlines, shipping, and manufacturing industrial needs. But what didn't happen during that process is production did not cease or did not reduce in time. If you remember correctly, several weeks ago, we had OPEC and Russia battling over agreed upon cuts. And then because of that, Saudi Arabia started a pricing war with Russia, dumping even more supply onto the market at very cheap prices, about $25 a barrel. It wasn't until April 12th where OPEC and Russia and Saudi came to an agreement to start cutting production by about 10%. And even at a 10% rate, it's not keeping up with the drops in demands that we're seeing. So we're seeing a glut of oil into the market. That's our first problem. The second is the way oil is traded. Oil is traded on future contracts around the world. The way a future contract works is you buy a contract of amount of oil at a specific price to accept delivery on a specific day. So that means if you go out and buy one contract, it's usually 1,000 barrels, and on that specific day that's agreed upon, you're going to take that into inventory or put it into storage. So let's talk about that storage. We have all this excess supply. Where is it going? Global storage around the world is estimated about 6.8 billion barrels of capacity. It's currently running at about 65% full capacity. So there's not much storage left in the world. But specifically, the United States critical storage unit out of Oklahoma is running at almost 75% capacity. In fact, it has estimated less than 21 million barrels of room left, which is less than 2 days of US production. So what we saw on Monday was the May contracts for oil, US oil being delivered. It was the last day of possible trade, and before that delivery was locked in, and they had nowhere to put it. Traders were desperate to move those contracts and were selling at any price. So by the end of the day, they were selling at negative $37, meaning the buyer was receiving $37 per barrel just to take those contracts into storage. The only other option is, if you're a refinery, is to take that into your own storage and refine the product. But of course, the demand's not there for that product to move through. So that's been a big problem. And that was the May's contract. So what does that mean? Does that mean we're stuck at these low prices? No, it was a one-day affair, negative impact. The June contracts actually bounced back, trading about $22 a barrel, and they're fluctuating from there. 22 is still not a strong price for oil. In fact, at that level, most Canadian and US manufacturers and producers will have to shutter doors, will have to cut costs, dividends will go away, and we'll see, the longer that lasts, we'll see bigger and bigger impacts, including more and more layoffs, which of course continues the problems that we're seeing in the economy. What it does mean for us, potentially cheaper gas in the short term, but in the longer term, we don't know where things are necessarily going to go from here going forward. We do see possible government bailouts, government assistance to the sector. But there's a lot of controversy around that, of course, with the global warming. Should governments be assisted in the oil sector? Should they be left to find their own way out of that? We're seeing the possibilities of loans. We could see governments shutting down production, and we've already seen the U.S. this morning coming out asking for Chevron to cease all production out of Venezuela as one step to reduce the new inventory. The governments themselves may take some inventory into their special reserves, but we have not seen that yet, and those are near capacity as well. We will likely see OPEC coming out with further reductions in global production, but not sure if that will be enough. It will very much depend on how quickly the economy starts up again and how much demand recovers from here and how long that takes. People may not be as quick to jump into their cars or onto planes as they were before, so global demand could remain low for quite some time. That's where we are today. We'll bring you more information as soon as we get any new data, and by all means, stay in touch with us if you're looking for any new or updates for these or any other type of market-related issues. Thank you all. Hopefully you liked it. If you do, click the like button. If you'd like to subscribe, click that. And by always email us, phone us. We're always happy and always here to help with your portfolio and planning needs. Thank you.